Every April, millions of people engage in a ritual. You open your laptop, stare at your W-2, and watch a significant chunk of your life's work evaporate into the treasury. You're told it's the price of a civilized society. But while you're calculating deductions for a home office or a kid's braces, the ultra-wealthy are playing a different game entirely. In 2018, Elon Musk paid zero in federal income taxes. In 2011, Jeff Bezos did the same. This isn't a story about illegal tax evasion. It's a story about tax avoidance, the perfectly legal high-stakes engineering of wealth that makes the IRS look like a voluntary donation bin for the elite. The first secret is simple. The rich don't have jobs. They have assets. Most of us live on ordinary income. The government loves income because it's easy to track and hard to hide. It's taxed at the source, but billionaires live on unrealized gains. Think of it like this. If your house triples in value, you're richer on paper, but you don't owe taxes until you sell it. Billionaires apply this logic to everything: stocks, art, real estate. As long as they never sell, they never realize a gain. Their wealth grows by billions, but their taxable income stays at zero. But you might wonder, if they never sell their stock, how do they buy the super yacht? Enter the Holy Trinity of tax avoidance. Buy, borrow, die. Step 1, buy. They acquire assets that appreciate, like Amazon stock or Manhattan real estate. Step 2, borrow. This is the magic trick. Instead of selling stock to get cash, which triggers a 20% tax, they go to a bank and take out a portfolio line of credit. They use their billions in stock as collateral. The bank gives them cash at a tiny interest rate, let's say 3%. Since a loan isn't income, it's tax-free. They live a billionaire lifestyle on borrowed money, while their stocks grow at 10% or more. They are literally making a profit on the money they borrowed to live. Under a rule called the step-up in basis, when a billionaire passes away and leaves that stock to their heirs, the cost basis resets to the current market value. All those decades of growth, the taxes are simply erased. It's the ultimate get-out-of-jail-free card, passing through generations without the IRS ever touching the principal. If the buy, borrow, die strategy is the foundation, trusts are the fortress. Take the GRAT, the Grantor Retained Annuity Trust. It's a legal vessel where a billionaire puts their assets. Any growth in value above a small hurdle rate set by the IRS passes to their children entirely tax-free. It's so effective that even the U.S. Senate introduced the GRATS Act in April 2026 to try and stop the billions leaking through this loophole. And then there's Delaware. You don't need to go to the Caribbean to find a tax haven. More than half of all U.S. public companies are residents of a single building in Wilmington, Delaware. Why? Because the state allows intangible assets like trademarks to be taxed at zero. A company in California pays rent for its own logo to its shell company in Delaware. The California company gets a tax deduction. The Delaware company gets tax-free profit. It's a legal shell game played with billions of dollars. When we think of offshore havens, we usually imagine a billionaire sipping a martini on a beach in the Bahamas while their money sits in a literal treasure chest. The reality is far more clinical and far more boring. It's not about the weather. It's about the secrecy. Take the Cayman Islands. There's a single building there, the Ugland House, that is officially the headquarters for nearly 20,000 companies. How? Because the Caymans have no corporate tax, no income tax, and most importantly, no requirement to reveal who the beneficial owner of a company actually is. To the IRS, the money didn't go to a billionaire. It went to a legal entity that, on paper, has no soul and no master. Then there's the British Virgin Islands, BVI, the world's capital of shell companies. It is the ultimate cloak of invisibility. In the BVI, you can set up a company in hours. It doesn't need to have an office, employees, or even a bank account in the islands. It's simply a ghost used to hold assets like yachts, private jets, or London real estate. When the asset is sold, the company is sold, meaning the billionaire never technically made a profit in their home country. But the biggest secret in the tax world, you don't even have to leave the United States. Welcome to South Dakota, the new Switzerland. While the world was busy hunting down Swiss bank accounts, South Dakota quietly rewrote its laws to allow Dynasty Trusts. In most places, a trust has to end after a few generations. In South Dakota, they can last forever. Billionaires from China, Europe, and Silicon Valley are moving trillions of dollars to the American Midwest because it offers the strongest asset protection and secrecy laws on the planet. In this game, the best way to hide money is to hide it in plain sight. For the tech giants, the strategy was even more mouth-watering, the double Irish with a Dutch sandwich. By routing profits from Europe through one Irish subsidiary, then a Dutch shell company, and finally a second Irish subsidiary that was tax resident in a place like Bermuda, companies like Google and Apple could legally move billions out of high-tax countries while paying an effective tax rate of less than 1%. The EU has since cracked down on this specific sandwich, but the chef hasn't left the kitchen. They've simply moved on to treaty shopping, picking and choosing which country's tax treaties they want to use, like a consumer picking a Netflix subscription. We often see headlines of billionaires donating half their wealth. It sounds noble, and often it is. But philanthropy is also the world's most sophisticated tax hedge. By donating to a private foundation or a donor-advised fund, DAF, they get an immediate, massive tax deduction on their income. But here's the catch. They often still control the money. They can appoint family members to the board, pay them salaries, and decide exactly where the money sits for decades. The money leaves their net worth for tax purposes. But the influence and the power of that money never leave their hands. The world is starting to push back. In April 2026, the UK officially began treating carried interest, the performance bonus for hedge fund managers, as ordinary income rather than capital gains. In the U.S., states like California are floating wealth taxes to capture a percentage of that unrealized mountain of gold. But for every new law, there is a new lobbyist. For every closed door, there is a new trust structure. The rich don't avoid taxes because they are evil. They do it because the system was built by people who own assets, for people who own assets. The tax code isn't just a list of rules, it's a map of power. And as long as wealth is taxed differently than work, the hill you're climbing will only get steeper, while the view from the top remains entirely tax-free. The question isn't how they do it. The question is, if you were in their shoes, would you do any different? Are the rules broken, or are they working exactly as intended?
Subscribe, because the next story might shock you even more.